Welcome to Objective 5 in Unit 7 in Accounting 3310. In this unit, we're going to talk about contingencies, which is one category of transactions, some of which appear on the financial statements and some of which only appear in financial statement footnotes. One off-balance sheet liability is typically listed in the category of commitments and contingencies. What are contingencies and how do they impact financial statements? Students will be able to classify contingencies at the end of this objective. What is a contingency? A contingency is an existing condition, situation, or set of circumstances involving uncertainty as to possible gain or loss that will ultimately be resolved where one or more future events occur or fail to occur. Contingencies can be gain contingencies or loss contingencies. Loss contingencies can be recognized on the financial statements of a company, but gain contingencies are not. If we recognize gain contingencies, there would be the possibility that companies would unscrupulously overstate their gain contingencies, and there would be no objective way to sort out which ones should and should not be recognized. On the other hand, loss contingencies have a greater import to the financial health of a company, and so loss contingencies may be recognized on the financial statements. It depends on how probable these loss contingencies are. These are the levels of probability that are used to classify loss contingencies. The highest level is called probable, which means that it's likely to occur. The lowest level of probability is remote, which is defined to be just a slight chance of occurring, and everything that's in the middle is considered reasonably possible. When are loss contingencies recognized as liabilities on the balance sheet? Loss contingencies are recognized on the balance sheet when they meet two criteria. They must be probable, that highest level of probability defined previously, and estimable. That is, there needs to be a way to measure the amount of the loss contingency. Second, when is a loss contingency disclosed in financial statement footnotes? Financial statement footnotes are used for disclosures when the loss contingency is merely reasonably possible or when it's probable but not estimable. Thus, loss contingencies that only have a remote probability do not need to be disclosed. Here are some examples of contingencies. A customer slipped and fell in front of a store and is suing for $5,000 of medical expenses. The probability of loss to the company is remote. The amount of loss, though, is estimated to be $5,000. It does not need to be disclosed or recognized. This is the kind of incident that probably has absolutely nothing to do with the store, and the store has defended against many times in the past. So if they have a legitimate reason for saying that the probability is remote, it is not disclosed and not recognized. The second one, the company alleges that improper disposal of used oil from company vehicles polluted a creek behind the store. There's no cost estimate for the cleanup costs. The probability of loss here, let's say that it's probable. The amount of the loss, though, is not estimable. So this information then is going to be disclosed in the financial statement footnotes, but it can't be recognized because there's no number to associate with this contingency and put on the balance sheet. Here's our third example. A product with a defective switch was recalled after shipments to 4 customers. No customers have filed suit yet, but they may do so. This probability of loss might be reasonably possible. There's no particular evidence that there's been any damage, but the business environment being what it is, it's certainly possible that the customers will file suit. The amount of loss is not estimable because we don't have the suit filed yet. We don't know how much they're suing for, and we don't really know of any specific losses associated with the defective switch. So, what do we do? Well, this is more than remote, so we are going to have to disclose this situation in our financial statement footnotes, even though there is nothing to recognize as far as dollar amounts. One category of a contingency is going through a lot of change right now, and so it's worth specifically mentioning. Self-insurance is a company's assumption of the risk of loss associated with events that could be insured against. Large companies that have many employees have a big enough risk pool themselves that it may be cheaper for them to directly pay healthcare costs than to pay premiums to an insurance company and have the insurance company provide the coverage. The typical risks that are subject to self-insurance are employee health coverage, but it could also include property damage or automobile insurance or something of that sort. Liabilities are accrued for self-insurance when a loss incident actually occurs. Because in accounting we only include changes in assets, liabilities, and owner's equity for past transactions, a company that self-insures for employee health coverage doesn't have a liability to accrue until an employee actually gets sick or actually avails themselves of health coverage. No liability is recorded for future events that haven't happened, even if they are in general predictable and estimable. The Affordable Care Act will affect self-insurance when fully implemented because these kind of plans are outside many of the rules developed for insurance plans and employers who pay premiums to insurance companies. So it's a little unclear how self-insurance will continue in the future. Here's an example. The company paid $500,000 in healthcare costs in 2001. The company here is paying the healthcare costs directly. The trend in cash payments for healthcare is such that healthcare costs for the company have been increasing at 10% annually. At the end of the year, there are claims filed for reimbursement of $60,000 that have not yet been processed. Claims for 2001 care can be filed within 3 months of the care being provided, so there are still 3 months in which claims can be made. And the estimate of unfiled claims associated with 21, estimated in part from the pre-approvals that we already know about, is an additional $80,000. What is accrued as a liability due to self-insurance at the end of the year? The $60,000 plus the $80,000 is all considered liability. They're all based on events that actually happened in 2001, and so the full $140,000 would be accrued. Estimates of future events are not included, and so we wouldn't say, if there's $640,000 of costs in 2001, then there's $640 costs as an estimate for 2002. Let's accrue that also. No, we're limited to the events that have actually taken place in 2001. This is the end of our discussion on contingencies.